Good morning, Mvula and Theo. It's so good to have you back in studio, the Real Assets Roundup, episode 2 for Global Listed Infrastructure. Theo, you've obviously been in studio with us. This, I think, is your third time, so you're no stranger to these type of episodes. Mvula, it's your first time. You live in Joburg, so thanks for joining us today. Now, you're the portfolio manager on both the SA-listed property portfolios at Catalyst, but also the global listed infrastructure. So I know you have your hands full, and coming in today, we really appreciate. Theo, it's the same on your end, also portfolio manager on global listed infrastructure, but you're also an analyst on the global property solutions for Catalyst. Now, what I understand about the asset class for listed infrastructure is that it's actually quite meaningful. People might be surprised that it's almost a third bigger than listed property. You've been managing and been in the property space for so long now, but I would imagine that there's a fair bit of crossover or similarities between your universes from property into listed infrastructure. Is that the case?
No, correct. I think if you look at it firstly from a sectorial level, our global listed infrastructure is actually exposed to some of the communication sectors that our global funds are exposed to, the likes of your towers and data centers. And now if you move over to the airports that the infrastructure product is invested in, the airport business model in itself is actually have exposure to real assets, the likes of your retail component of an airport, which of course we've been invested in for the longest of time, both on the South African funds and our global funds. Now, moving over geographically, our exposure on those funds are not too dissimilar. So exposure in North America, Europe, and some Asian regions are very similar to our UCITS real estate fund. So I think there have been some similarities that we've taken advantage of when launching this product.
Anything to add on your end, Theo?
Yeah, I would just say and other than that, also the underlying risks and return characteristics look very similar. There are different business models, but when you look at the cash flow yields and the kind of growths you're getting, they are very comparable. And I think for a long-term investor, both are worth serious consideration.
Yeah, I know we spoke last time on the case for listed infrastructure, and a huge part of it was, well, you've got the structural tailwinds, which really drive growth for the sector or the asset class. But on the other side, the real beauty about the asset class is it's quite defensive in nature. You've got these really predictable cash flows, durable income streams, highly regulated asset class, which in case of a lot of market turbulence and volatility, it should, in theory, be quite defensive. Now, we've had a good case study at the start of this year, and I know the fund even started on quite tough footing with the wildfires in LA. But then this year, we've now had the escalation in the Middle East in February, March. So how did the fund behave even the asset class towards the end of February in going into March, and maybe also compared to global equities, for example?
Yeah, the performance has been satisfactory, I would say, through this period. If you think about what actually happened, it was a disruption in energy, global energy, in oil and gas supply networks. And that meant that stable networks like in North America just became more valuable. On the flip side, as Mvula can attest, we were both at the airport on our way flying to the Morgan Stanley conference in New York when Mvula told me he can't get on the plane because flights through Dubai has been cancelled. So that obviously affected the airport volumes and traffic there, but that's a smaller component of the universe. So overall, the demand for security and energy has just increased, and the underlying businesses still kept performing well. Obviously, this is a listed product, so when risk multiples move out or spreads move out, it does affect everything that is listed. But we've been satisfied with how the asset class has held up, especially during downturns. You can look at previous cycles. During market sell-offs, infrastructure usually has a lower drawdowns because of the underlying stability of the cash flow streams.
And I think if you turn within the sectors now, within the asset class, energy transport, as Theo has mentioned, has actually outperformed year to date. Okay. Obviously, as a consequence of higher liquefied natural gases and oil and the like. But on the downside, we've seen transport subsector underperforming. Within transport, rail has done much better than your airports, and for obvious reasons. Currently we are seeing risks to the airport subsector, of which currently our fund is underweight. So we've done well being underweight that subsector, and I think in the short to medium term, given elevated prices of oil, jet fuel, we've seen limited, flights and cancellations. So obviously the demand now is impacting on the airport capacity, which we think will be a risk, obviously, for some of those earnings in the short to medium term.
I think you mentioned that conference. I don't think either of you will forget that the date of that conference. So Mvula was trying to get there via Dubai. His flight was not happening. Theo, you barely made it to New York, missing suitcases, but we got there. So unfortunately, Mvula, you couldn't partake in being at that conference, which is just part of your natural research process where you go and visit the relevant conferences offshore. But Theo, you were fortunate enough to be there and meeting with management teams of the large utility companies, etc. Were there any major takeaways that you took from that? And then when you came home and discussing with Mvula, has any of those insights come into the portfolio now and changed your outlook or changed any investment decisions?
Look, if anything, I would say it reaffirmed the view that utilities and the energy transport sector is basically in a capex super cycle. Massive investments are needed to upgrade the grids that are old, also to accommodate the transition from, let's say, coal power to more renewable power, and then to accommodate increased demand from a more electrified digital economy. If you think about how important data centers and AI is becoming, so there's a lot of capex that needs to be invested for the future economy that's a lot more digital and electronic. The majority of the businesses work on a regulated profit model, and I think this is quite an important point for investors to understand. In a nutshell, the asset base of the company and how that grows drives the earnings in the long term. So these are long-term capital-intensive projects. So companies usually have 5-year plus cycles visibility to the capex they're going to spend. And when a regulator approves these at an allowed return on equity, you have very strong visibility to the earnings. So, a lot has been said about the defensiveness of the asset class, but we're also now shifting into a kind of higher growth mode with strong visibility, where I think the one thing that stood out for me is how many of the companies I met with that gave 5-year plus earnings growth outlooks from anything from 5 to 8 or 10% per year. I mean, that is quite unusual if you compare to other general equities where companies would maybe give you quarterly or next year guidance. So I think the visibility to the growth is something that actually people underestimate.
Yeah, and I mean, just to add to Theo, I mean, unfortunately, I didn't attend the conference, but we've liked utilities, at least electric utilities, for some time. So, I mean, the fund is positioned within the subsector. I mean, it is a majority of the benchmark, circa 50%. So we've got a slight overweight there. But I think within the sector, what we have seen, and again, key takeaways from the conference was that there is actually dispersion in terms of the operators. Guys that are exposed to the data center load growth are seeing the upgrades to earnings, the likes of your Next Era, Integer, and the like. I mean, those are core portfolio holdings. We have started trimming over, obviously, given on the back of the re-rating potential and the re-rating outsized returns that we've seen from those names. So it is quite interesting to see those play out. It was obviously a key outperformer relative to the other subsectors here to date.
Yes, you talk about, short-term performance. It's done well. Relative to global equities over the long term or global bonds, for those that are new to the infrastructure and where it fits in a portfolio, how correlated are those asset classes? How are the performance profiles? How do they compare? How do they compete?
Well, if you look at one of the most widely followed benchmarks, the FTSE Developed Core Global Infrastructure Benchmark, I think a lot of people will be surprised over the last 20 years that has actually slightly outperformed global equities as measured by the MSCI Developed World Index. But the more interesting thing is it's done that at a lower volatility and as I said earlier, at lower drawdowns. So you can, because the operating earnings are more stable, so the beta to equities is about 60%, 65%. So, if you add an asset class that performs well with low volatility and isn't less than uncorrelated into a portfolio, that really improves the risk matrix.
Definitely, it's sounding more and more like it should be becoming a bit of a core allocation as opposed to being lumped in with global equities.
Look, we think it's still underappreciated. I mean, if you look at it as a size relative to global, it's still quite small in terms of market cap. But I mean, these entities are large entities. I mean, the likes of your Union Pacific, one of the bigger rail companies within our universe, co-holding. We think that the asset class is still underappreciated given the size that it has in the broader market.
It sounds absolutely exciting. We're going to close off now, but is there any final comments you want to make about the asset class, what you're most excited for, what you're nervous about, anything you want to leave?
Look, I think maybe total returns looking forward are quite important. I think, as the US mentioned, the returns year to date have been quite pleasing, even over 1 year, far beyond what we were expecting. I mean, generally, we believe over the long term, the asset class should be delivering anything between 8 to 10%. As we speak today, we're around the 12% mark for the fund, which is a marginal outperformance. There are opportunities within, obviously, the sector to generate alpha, but I mean, we are more excited about what the asset class can do over the long term. So, I mean, 8 to 10% in dollar terms, supported by earnings yield of around 5%. And I think we're expecting growth over the next 4 to 5 years of between 5 to 6%. So that is quite attractive, quite resilient. And I think that's one of the core characteristics that we like about the asset class.
Yeah, I mean, I think I would just reiterate what I said earlier. I think for a long time, especially utilities in this sector was maybe seen as a sleepy, kind of boring sector. But people shouldn't underestimate that shift in capital spending and that kind of the super cycle that we're entering, where earnings growth looking forward will be materially higher than it has been in the past. So if someone does homework on this and just look at what things have done over the last decade or two, they will probably miss a big part of the picture that will drive earnings going forward. So I think it's important to look at what companies are guiding to, what growth they are expecting, and also to understand how stable or how secure that is.
It's exciting. So for anyone who is doing homework and wants us to come check your homework, I'm going to pop my contact details down below. You can get hold of me or Mvula. I'm sure you wouldn't mind taking some client calls. But thank you for both being here. And I hope to see you guys very soon.
Thanks, Kerri. It was a pleasure.